Good afternoon. This is Kevin Baker with Bakes Takes. Welcome to my podcast. It's Saturday, June 12th. Hope you had a great week, and let's get right into it, folks. Why I do this, my sons, Bobby and Jack, they're in their 20s. They are recent graduates of undergraduate business programs, and they would fire me questions, and then it just grew organically. I've been in the investment business for 25 plus years. I went through the 87 crash when I was a broker, and got my head handed to me, and really went back to study, so I made sure that never happened to me again. And so I discovered technical analysis. I've studied it extensively. I've read 500 plus books at least. I use the charts first, the fundamentals second. It's not right or wrong. It just works for me. I read maybe the things you don't want to. The Journal, Barron's, Economist. I devour relevant newsletters. I listen to dozens of podcasts, and I monitor what my Google alerts are bringing up about these crazy themes that I uncover. And know that if you want to do that, I always point to it, give attribution. But if you don't, I hopefully in a half hour, the good use of your time, I'm going to tell you what went on in the past week and suggest ways that you can invest more intelligently and effectively. I eat home cooking. All I do is talk about what I invest in, what I'm interested in, and I don't have any conflicts, so I can't be much more transparent. Please tell me, what are your pain points? How can I help? Problems you'd like solved? Topics I should cover? Thank you for the support, and thank you for the suggestions. I'll always do a free version of this, but I'm building premium levels where we go more in depth given the feedback that you're giving me. We're going to probably use Supercast or Patreon, something like that, for weekly calls with me, discussing charts more in depth. Maybe I teach technical analysis in a more thorough fashion, more organized fashion. You help me design the show. Guests that I should reach out to, where I should appear. Do you want to have a text like I send to my sons when we do a trade? 610-331-4283. Please fire away. This is my disclaimer. This is not investment advice. Please conduct and share your own due diligence. The more that happens, the more we grow, the more fun we have, and the more money we all make. Fan mail. And, AMC comes up all the time. Been a crazy week for the meme stocks, to put it mildly. And I'm not going to go through everything we've talked about. It's all there on the record, and I've shown that several times on the YouTube channel. Please go to the YouTube channel so you can see. This is great if you're working out or walking the dog, but if you can see the charts and graphs that I reference, it's a big help in my opinion. So this is from the April 24th show, and the stock was at $10. And I pointed out that this was a pretty compelling looking wedge. It could have broken to the downside or the upside, I pointed out, but the volume was picking up pretty meaningfully on the up days, and that suggested the potential for upside surprise, especially when you had 93 million shares short. So fast forward to this past week. This is the monthly chart that I show here, and the stock's at $49. So 5 times your money in 2 months. I didn't see that coming. I'm not going to kid you, but I said that if it broke the 1444 level, you had more upside to come. It's just the way the charts work when they take out resistance. And we sliced through the 3350 level that I pointed out here, which is a double top all-time high prior to this back in 2013-14. We sliced through it like a knife through butter, way more easily than I suggested at the time, and I'm still surprised about that. The reason I bring that up is I think that's now support. So if we pull back, my suspicion is around the 3350 level, and it isn't that precise, but around that level are going to be likely points where you pick up some buy orders if you have ensuing weakness. Now, I believe that it's smart when you have a 5-bagger in 2 months to take the original investment off the table. That's what I did with the Grayscale Bitcoin Trust, and I just think it's smart money management. It's smart risk management. It's also good psychologically. You've already booked your original investment, and this is pure profit that you're staring at right now. And I just think it's a great way to operate and manage your risk. So to the holders, God bless you, and best of luck with AMC going forward. But I think we had a pretty good call. and we pointed out that out in great detail. This is a update. GS at G Spatuzzi on Twitter reached out to me and asked me to refresh this. This is from April 24th. And I said something to the extent of, I can't believe I'm saying this, but if we break above $212, the stock was at $151 at the time, so it seemed outlandish, hence the way I phrased it. And I said, if we break that, we're going north, and holders rejoice, something along those lines. And so here's the exact chart from that show. Here's the wedge. Here's the big volume days that I pointed out. And then let's fast forward again to today. This is still the daily, but the stock's at 233. So we made 60% of our money, give or take, in 2 months. Now that's a pretty good way to go through life. This can be a lot of fun sometimes. And when it is, I think you should take take your chips off the table, take the original investment out, and let the winners run. So that 212 level that I mentioned so extensively is now support. And it's just fascinating to watch these things work. We hit a high of 345, and then Thursday, Friday of this week, we came down and kissed 211 and 207 and finished up at 233. So 212 to me looks like support from here. We probably bounce around this admittedly wide range, 212 to 345. And if you break above 348, we're probably going to challenge the 483 all-time high. Personally, I think that's very unlikely because we had the earnings report this past week. The stock yawned. We had the new CEO announcement that everybody was looking for, and the stock yawned. So I don't know what's going to happen now with all the shorts that have been brought down to make this meaningfully go to the upside from here. It would have to be some sort of digital transformation news that dazzles people. I lack the power of imagination to see that at this point in time, but here it is. So the wedge worked. We took out 212. Everybody made some money, I hope, and I think that bring your expectations down from here on out. My son Jack loves SoFi, SoFi, likes the service, and wanted me to talk about the SPAC to public transformation of SoFi. Chamath Palihapitiya had a SPAC, and he brought SoFi public via that vehicle. Obviously, this is the daily. There's very little history. It's only been public for a couple of months now. But it took out the 1864 level. That's now going to be support. You have resistance at just under 25. So again, we probably bounce around between those two levels. The volume is picking up on the positive days, which I like. And Jack, you like the service, and I like the chart. So if you can pick it up more at the 18, 19, 20 level, better. But it looks like a very promising stock to me. Next, Charlie S. out of New York City asked about playing or participating in the commodities supercycle, and said, Bakes, I'm looking at select materials from Fidelity. What do you think? And so I go to the monthly chart here. No, keep going there. Sorry. The monthly chart here, it's a moonshot. I mean, it went from the depths of COVID down to 45, and here we are at 110 or so. So my first inclination is this is not a new theme that's being unearthed by investors. It looks very solid. It's in a clear uptrend. It's clearly bullish. We talk about this area a lot in our work, and then I wanted to see what commodities that they're invested in. So I do what I always suggest you do: go to the fact sheet, and all mutual funds, all ETFs have these fact sheets, and go to the top 10 holdings and see, and this is really what's going to drive the returns. And when you do that for Fidelity Select Materials, you realize, okay, at the top is Freeport-McMoRan, copper and gold, aptly named. Those are clearly commodities. But then you go Air Products and Chemicals, Sherwin-Williams, paints, Ecolab, cleaning chemicals, International Flavors and Fragrances, self-explanatory. Then you have Newmont Corp, which is almost a pure gold play at this point in time. So it's certainly these are beneficiaries of the strengthening economy, the stimulus, the reopening, but they're not commodities pure plays, so to speak. So just so you know that you can still make money, but I just point you to our portfolio, and we're playing the commodity super cycle, but we're I hate that word playing, but participating in exploiting via uranium, where I think that the uranium bull story is stronger than any chemical story that I could come up with. And argue with me if you want to, have at it, but I think that uranium is playing a commodity super cycle. Copper, pure, absolutely. The agricultural commodities, sugar, soybeans, wheat, corn that we own through tags, the TAGS ETF. So we were commodities before commodities were cool, that kind of a thing. So here's my take. I think in the case of AMC, I think you should hold the stub, if you will, the remaining shares after you've taken out your original investment. Same with GameStop. Jack, love you, can't wait to see you, and I like the SoFi chart. And Charlie, I like FSDPX. I think it's positive, but I think it's later in the cycle than the commodities that we've espoused here. And I'd love to have your feedback. Tell me where I need to elaborate or clarify. Thanks. Please share this with your Robinhood or Reddit friends, Wall Street Bets friends. Send other stocks ideas. I'll offer strategy for them as well. And please stay tuned. Next, my themes and groups. And Grayscale Bitcoin Trust has been great for us, but I sold it. And I sold it because I have a sell discipline that I stick to, and it just flat out works. I've gone through that extensively in the past. If you want me to reprise that, I'm happy to do that. But after going through literally dozens of historical charts, I have found that if you sell a third of your winners when they break the 200-day close below the 200-day moving average, that it works. It just flat out works. And then if you sell another third when the 50-day comes down through the 200, that works. And then when the 200-day turns down, you want to be gone and off onto new things. And it isn't perfect, but it's better than other sell disciplines that I've seen. If you've got something better, have at it. We nearly tripled our money in the Grayscale Bitcoin Trust. I am long-term bullish on Bitcoin. I think it should be part of that base of the triangle that I've talked about, where you have cash, gold, and Bitcoin to weather whatever the future COVID black swans are going to be. And I just think it makes sense. The currency is clearly debased. I think Bitcoin is a long-term solution. I just want to show you the portfolio, show you the discipline, and frankly prove that it works. And it does work. We're out, and I have no problem. By the way, I was kicked out of Bitcoin before and got back in because I had the capital, because I had a sell discipline. So I really recommend this, and follow along, please. Next is charts and tweets, posts of the week. Jeff DeGraff from Renmac. Very good technician, good guy, like him. And he points out here in a clever chart, when you have positive earnings surprises that are abundant, tech tends to suffer on a relative basis. I am not a relative investor. I'm an absolute investor. The whole institutional world is catering towards beating an index. And this is what I really like about our individual focus is we just want to make money every single year, compound positive returns, and avoid big losses. And we can do it because we don't have the same institutional constraints that are so prevalent in the industry. So I point you to that. Bottom line is the earnings surprises are happening, and tech is following suit and behaving very sluggishly. So just a reminder, you own stocks, you don't own positive earnings surprises, and you have to focus on the former, not the latter, and I hope I've been helpful. This is the from Uranium Insider, great Twitter account to follow in my view, And this is the history of the uranium ETF URA, the older one, Global X. URNM was created maybe a year or two ago. And this is just great perspective. And please look at the YouTube channel to see this. We hit a high, URA hit a high of 134 back in February 2011, 10 years ago. Fukushima hit, and the tsunami hit Fukushima, and obviously uranium got crushed hard and fast to a low of $7 in March of 2020 when COVID hit. We've made a lot of money. Now URA is up to 23, so it's a triple off the low as of right now. And the point I make is, I think, just looking at this history and looking at the fundamentals, we're in inning 2, maybe 3 of this ball game. And I think that a retest of old highs is very plausible over time as the bullish forces come to be realized by the marketplace. And that means you're going to make 5 times your money. There's no guarantee, obviously, or more. I think you can make more. And so my take is, I think tech's going to be sluggish for a while, and I think you should probably de-emphasize it in your portfolios. And uranium is in the 3rd inning, and I think we can go into extra innings and make 5 to 8 times our money. And this is going to be a lot of fun. And stay tuned. Next, newsletters of the week, and this is a new one. Share Scoops, good friend of mine, Riley. Thank you very much for the introduction to Gus, who is the CEO and founder of Share Scoops, and great to meet him. Had a great conversation, and I recommend Share Scoops. Please go. He's got 23,000 plus Instagram followers. Add to that, please. Please go get on his email list. Refer him. And I'm not being paid for any of this. I just like the guy, and I like his message, and I like his mission, which is to bring into concert your people's values with their money and their investing. And it's an ESG focus, environmental, social, governance, and frankly a little bit more than that. When I look at his newsletter and Instagram account, and he's targeting people who are perhaps really new to investing. My audience might be a little bit more ensconced in the investing world, but be that as it may, I think we can all help each other. I want to help him grow. I hope he helps me grow. And go to Share Scoops and see what you think. And I'd love your feedback, and I'm sure Gus would like your feedback. Next, Bear Traps Report. This is Larry McDonald and his team, and he and I are bullish on copper, and he puts together a great combination of all the miners and their capital expenditures over the years. And bottom line is, it's been in decline for 10 years, and we have a supply problem. Demand is incredible, and the point being is that it's going to take years for a supply response, given the way CapEx has been slashed in the mining business. And so stay tuned. It's going to be a lot of fun for copper. Next is copper supply. There's been 224 copper deposits found in the last 30 years, but only 16 in the last 10. So the grades are going down. It's harder to find. They're in harsher environments, tougher political and government regions. And again, there will be a supply response, but it will be muted, and you're going to need higher prices to make people open new copper mines. And I just think it's going to be a lot of fun for the next few years. Silver, he's bullish on silver, as am I. He points out it's the best conductor of energy, electricity globally. It's the most important material in solar, electrical vehicles, EVs, 5G wireless. And if you want to get to net zero ambitions, you have to include silver in that mix. Analysts looking for $50 price targets. We're at 28 right now. So so there's an industrial component here that is very bullish for this precious metal. Also, Wall Street is starting to join the bullish chorus, if you will, And to put things in perspective, there's $1 billion ounces, $2.28 billion. I mean, that's forever. All the ounces that have come out of the ground since Judas is 28 billion. And you have to multiply that by 77 times to get to the currency in circulation. So as currencies are debased, silver is a very logical hedge at minimum. So from a monetary and industrial standpoint, silver looks very bullish for the foreseeable future. Next, uranium. And I kind of pound this home because when people ask me for new ideas and I suggest uranium, they almost sigh and look bored. And they want to hear, frankly, what's in their portfolio, which is what we all do. And because I don't say Apple and Tesla, I say uranium, they get disgusted with me and they leave. But we're up 2x plus on URNM, the North Shore Uranium Trust, and there's more to come. So, and this is maybe to Gus and Share Scoops and that audience that the planet can't go 100% green without a meaningful nuclear power renaissance. It just can't. And so I want you to consider recasting your ESG definition to strongly include uranium. It just makes sense, and more on that. The winds are changing. John Kerry is positive on nuclear power. CNN and 60 Minutes have been talking up nuclear power. Left-leaning news organizations. So this is starting to change. The asset managers that are out there are paying attention. This is a very small investment pool, and I want you to get in before the big boys really do. And I think we have years to go here. Supply is small. It takes 10 years to get a new uranium mine up and running. So again, the supply response is going to be tough. Number 4, there's a lack of experts. People left the business when you have the uranium go from 134 to 7. So he also talks up URNM's, the ETF specifically that I like, and that the pricing power that these companies are going to enjoy is substantial. Geologists that he talks to say that we need 150% more uranium than we have today to meet the nuclear power needs that are out there. Number 6, electrical car sales, EVs, reached 2.3 million in 2020. That's up fourfold in 5 years. And the aspect of this that is lost on people is that if this keeps going, the electrical grids are going to crash. And so you need to have substantial increases in electricity supply. Renewables don't work 24/7. Germany found that out. Texas found that out. And it's another bullish point pointing to uranium and nuclear. China is now increasing its nuclear power substantially. Number 8, they're going to have to double their nuclear power plants to meet their 5-year plan for zero carbon emissions. Uranium is in tough places. Greenland and Sweden have banned uranium mining. So again, the supply response is going to be tough. And number 10 is long bear markets destroy Wall Street's interest. And so they're not going to be out talking about this substantially until most of the investment gains are behind us. And we've already had a double, and there's more to come. So we have years to go on this, and I await your feedback. But I want you to consider uranium, especially if you have an ESG bent to your investment philosophy. Next, the City Inflation Surprise Index. We just had 2 big CPI numbers, and that tends to be bearish for NASDAQ. And it culminated in 2 Fridays ago, this bearish reversal, an inside-out day where you hit a new high and you close below the prior low. And it looks bearish for the NASDAQ 100, and I think that that dovetails with a lot of the other things that we just discussed and that I'm seeing. So here comes Apple, the number one S&P component, the number one tech stock, and it looks like a bearish head and shoulders top. And if it breaks this neckline, there's more room to the downside. and it seems tired to me. It doesn't react to positive product news. I just caution that if you're a big Apple fan, you might want to take some chips off the table, de-emphasize it, and the same thing goes for Tesla. I know this is, it was a ridiculous year last year, and you have to at least consolidate gains when you have that kind of a move over the course of last year. It's now in the S&P. The story is well known. The competitors are piling up. I pointed out on the May 22nd episode of Bakes Takes at around 10 minutes or so that Scott Galloway has predicted SEC trouble for Elon. It looks like that's coming. So if you're a Tesla shareholder, keep your head on a swivel and watch the 200 day, and which has already broken a little bit so far. Next, here's Barclays coming out. Here's Wall Street, initiating a report, nuclear for a decarbonized future. So this is happening, and we started talking about this in June, July last year, and so I think we served you well. And if we have, please bring more people to the show. So here's my take: if you care about ESG, you ought to own URNM, North Shore Uranium Trust. Period. I think copper and silver are going to be bigger winners than what I see inside the Fidelity Select Materials, FSDPX, although I think it's going to work out fine. And I think tech should be de-emphasized. Apple is going to mean it's going to be tough for the S&P to make a lot of big upside moves, and Tesla looks heavy to me. So there we go. Please also subscribe to my Bakes Takes YouTube channel. The audio is the same, but the charts that I reference are on the screen. Please follow us on Twitter at BakesTakes_ and other social media. Please use your voice memo app. Tape your questions and email to bakes@bakestakespodcast.com, or write in if you'd prefer. I'll keep you anonymous if you'd like. Thank you for listening. Mike Wilson is my producer. Thank you as always. Have a great week. This is Bakes. And for much needed levity, this is a little bit old, but oh my God, is it funny. This is Lisa Lampanelli roasting Gene Simmons, the bassist of Kiss. And it's R-rated, full disclosure, but it is absolutely hysterical and spot on. And I hope you enjoy it, get a chuckle, and I will see you next week. Thank you very much. Take care now. Bye-bye.